Okay, good late afternoon, everyone. I'm Deborah Lucas, the director of the MIT Golub Center for Finance and Policy, and I just want to briefly welcome you all and thank Loretta Mester very much for being here. In terms of a formal introduction, I'm going to hand it over to Professor Rosengren to introduce Loretta, and I think he'll tell you all you need to know about asking questions and all of that. There you go.
Great. Well, thank you very much, and thank you everybody for being here. We invited people from the Boston Economics Club as well as the MIT community, in part because monetary policy is such a hot topic right now. We thought it was particularly appropriate to also open it up to finance professionals in the Boston area. And I'm going to let Mark just say a couple things. He's the president of the Boston Economics Club, and thank him for his willingness to work with us on this.
Oh, absolutely. Thank you, Eric, for including the Boston Economic Club as well. So many of you already know about us. We've been around since the Great Depression, and we've been getting thought leaders, topics, ideas, and actually good speakers together over a lunch format since then. And so we felt that this was a great event. In regard to President Loretta Mester, I'll just say a few things. In particular, I being a former Fed person, I remembered reading some of her research early back in 1985 when she started at the Philly Fed. In particular, in 1985, inflation was roughly 3.61%. Now, before she started at the Fed, inflation was over 10%. So do you see the trend? It's very positive. At the Philly Fed, she did research in credit markets in particular. Very interesting work in that area. Pricing of credit cards as well. How do you effectively price that? But what's most interesting is a lot of work that she did in inflation. Now, importantly, she was at the Philadelphia Fed, and she really set herself out very early and became an executive VP, head of research. And quickly after that, it became very evident that she was destined to do more than just research. So at the Philly Fed in 2014, she was basically lost and promoted to head up the Cleveland Fed in particular. Since then, she's actually sat on the Federal Open Market Committee, what we call the hot seat, which is extremely important, I think, for the discussion today. You know, if we think about the global economy today and where we are, it's quite interesting, right? We have high inflation, high interest rates. We have currency wars that are happening all around us. There's talk about, maybe I should just whisper it, stagflation, right? And then also concerns about recession. So all of this combined, who better to sit, right, around that table than President Loretta Mester. So thank you very much.
Thank you, Mark. Let me just add one or two personal comments, because not only is she a very accomplished economist and done wonderful work in banking, credit markets, and macroeconomics, but I sat at the table for many, many years and know what kind of respect people have around the table for the kind of work that Loretta does. And I can guarantee that when Loretta speaks around the table, people really do listen. She's not only an expert in monetary policy and banking, she's also delved into a number of the payments areas, which frequently gets lost when people think about what the Fed's doing, but it's actually an extremely active area right now. And it's very unusual in the Fed to be both a payments expert, a banking expert, and a macro expert. And Loretta actually does provide that. This is a wonderful time to have that expertise. So Loretta, thank you. I enjoyed all my time serving on the committee with you, and it's great to have you here at MIT.
Well, that was, thank you very much for all that. Eric, I have to say that, you're talking about our time together at the Fed, and I have to say that, I think I've known you my whole career as an economist, and I really just remember all the times that we kind of sat at the table and talked about, economics and financial stability. And I learned a lot from you about your views on the economy, on monetary policy, on financial stability in particular, is something that you really brought to the Fed, where, you created a Conference of Presidents Committee on Financial Stability to make sure that we were actually paying attention to that. And I not only learned from all those conversations, but I also learned how you led your Reserve Bank, and that really helped me. in my role when I took on the role at the Cleveland Fed. So I'll always remember that, Eric, and I certainly appreciate what you said, and I appreciate the invitation from the Golub Center today. I don't think it'll be surprising what I plan to speak about today, which is inflation and inflation expectations in particular, and also sort of what's the appropriate strategy for monetary policy when there's a lot of uncertainty about both the path of inflation and the path of inflation expectations. And I will, of course, remind you that the views I present today are my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. And I have to say, this is the first in-person speech I've given with slides, so I'm going to mess them up, I'm sure. So I beg your indulgence here. So let me see if I can advance the first slide. And I'm already having trouble here. Should I just use this guy? All right, let's do that. That's easier. All right, so the key challenge facing the economy right now is unacceptably high inflation. Inflation's been running well above our 2% goal for well over a year now. It's very high not only in the US, but also in other countries across the globe. And, you know, the high inflation has a lot of different factors that are driving it, but fundamentally, it's an imbalance between strong demand and constrained supply. And that's basically put significant upward pressure on prices. It's a top concern of households and of businesses. If you look at survey evidence, you see that. I do a lot of conversations around the 4th District with both consumers and with businesses, and they point to inflation as being one of their top concerns. It's imposing a particularly onerous burden on people and businesses that don't have the wherewithal to spend more for essentials like food and shelter and energy and gasoline. And now they're having to make some really hard choices about how to spend their money, their pocketbook. Now, price stability, of course, you know, is one of our goals at the Fed. It's the foundation of a strong economy. It's necessary for ensuring the U.S. can sustain healthy labor markets over the medium and longer run, and that the economy can actually live up to its, to be productive and live up to its potential for everyone's benefit. When you have stable prices, it means that businesses and households don't have to spend time trying to, you know, protect the purchasing power of their money. They can make long-term plans and long-term commitments without having to deal with the uncertainty about the value of their money. And, you know, price stability and monetary policy, as you know, are intimately linked. But because of the uncertainties around the economy and around inflation dynamics, setting monetary policy to achieving price stability is not trivial. It requires being able to measure inflation so that we understand where inflation is relative to our goal. It requires being able to forecast inflation because monetary policy affects the economy with a lag that varies over time and with economic circumstances. It requires understanding the determinants of the monetary policy transmission mechanism. And it also requires having the ability to make decisions under uncertainty. So, and the Fed hasn't always been successful in achieving price stability, and there's been misses on both sides. We heard about the Depression a minute ago, right? During the Great Depression in the 30s, the US experienced deflation. And then in the aftermath of the oil price shocks in the 1970s, inflation surged and remained high until then Fed Chairman Paul Volcker began to tighten monetary policy to bring inflation down at the cost of a deep recession in the early 1980s. So the Fed has learned from these historical episodes, and one lesson that is very important and significant is that the central bank knows that remaining focused on its price stability goal is crucial. So the FOMC is committed to using its tools to bring inflation back down to our longer run goal of 2%. Last week, we took another decisive action to remove monetary policy accommodation. We raised the Fed funds rate by 75 basis points. And we're continuing the process of reducing assets off of our balance sheet, which also reduces accommodation. Now, the mechanism is such that, we reduce monetary accommodation, we'll tighten financial conditions, and help to bring demand into better balance with supply in both product and labor markets, resulting in an economic transition to growth in real output that is going to be well below trend, to slower employment growth and a higher unemployment rate. So let's look at some pictures. So inflation continues to run at rates last seen in the early 80s in the US, and that's true whether you look at CPI inflation or PCE inflation. The strong increase in inflation that started in the spring of last year is very different from what the US experienced during the long pre-pandemic expansion. If you recall, until late in that expansion, the main concern was about inflation running below our 2% long-run goal. And that was true in other advanced economies as well. And there were several factors that contributed to that low inflation at that point. In the aftermath of the financial crisis, global demand was weak, prices of energy and other commodities were declining, and in the US, a rise in the value of the dollar put downward pressure on the prices of imports in the US. If you think back to that, the puzzle from 2009 to 2011 was really not why inflation was low, but why it wasn't lower than it was. And a major reason of that was that longer-term inflation expectations were relatively stable at levels consistent with that goal of 2%. So I'm going to spend some time in the talk later on talking about inflation expectations. But if you go back even further before the Great Recession, inflation had been stable, right? If you look at the period between the mid-'80s up until the Great Recession, it had been relatively stable in spite of some wars, dramatic run-ups and downs in oil prices, and some mild and more severe recessions. And the fact that inflation has become less correlated with changes in resource utilization in the labor markets and in product markets, that the lingo is there's been this flattening of the Phillips curve, right, suggested that there had been a change in inflation dynamics. Now, that hypothesis may still hold, but I think it's an open question as to whether inflation dynamics have once again changed, or whether the factors that held down inflation prior to the pandemic will exert their force again over time. Now, the overriding message from a variety of measures is that inflation is not only high, but it's now broad-based. Again, thinking back to last April 2001, right? The rise was concentrated in a limited number of categories that were directly related to the effects of the pandemic. But by later last year, those price pressures had broadened across categories. So it's certainly true that energy prices have been a major contributor to the rise in inflation. Over the last year, the PCE Energy Price Index has increased over 30%. Recent readings have eased in energy prices, but if you look forward, developments related to the ongoing war in Ukraine suggest that gas and energy prices could move higher again later this year or early next year. Food prices have also risen significantly, and inflation in this component is at its highest level since the late 70s. But even if you take out those food and energy components, core PCE inflation is at its highest level since the 1980s. Now, the nature of the pandemic shock and the response to it affected aggregate demand and aggregate supply. The mandated shutdowns and the voluntary pullback in demand for high contact services led to a shift in spending early in the pandemic from services to goods. And then when the economy reopened, demand surged. And that demand was supported by fiscal transfers and accommodative monetary policy. Now, we do see a shifting going on. Spending is beginning to shift from goods back to services, but neither is back to its pre-pandemic trend. Now, while demand was strong and surging, right, it was met by constrained supply. We have all heard about the supply chain bottlenecks in the product side of the market, but there was also withdrawal of workers in the labor market. Many of our contacts in the district and many economists thought that those supply constraints would work themselves out fairly quickly, but that didn't prove to be the case. There were rolling pandemic lockdowns across the globe in response to new waves of the virus, and there's been a sluggish return of workers to the workforce. So it really made it difficult for supply to keep up with demand. Again, when we talk to business contacts, they tell us that, we've learned how to navigate around the supply chain disruptions. They're still challenging, but we've kind of learned how to do it. Their focus now is on the fact that they really still cannot get workers, and they cannot get the workers they need. Okay, so we still have this imbalance between supply and demand. That's really increased inflationary pressures. Both goods and services inflation are rising. Goods inflation is still outpacing services inflation. And that, again, is very different than what we saw pre-pandemic. Before the pandemic, goods inflation was actually slightly negative on average, and falling goods prices were helping to pull inflation down. Now we don't see that. So consumers spend a larger share of their spending on services rather than on goods. So services have a higher weight in the inflation measures. So that's why there's this focus now on looking at services inflation. And the other reason there's a focus on that is that services inflations tend to be more persistent than goods inflation. If you look at an important component of services, housing, as measured by rents or imputed rents for owner-occupied housing, it's a large and cyclically sensitive component of services inflation. Shelters about 1/3 of the CPI price index. And early in the pandemic, you saw, there was high unemployment, there were moratoria on foreclosures and evictions, and that put downward pressure on house prices and housing inflation. But subsequently, there's been a rapid rise in house prices and rents. So even though there's been a pretty dramatic, I'd say, pullback in housing activity in response to higher mortgage rates, there still is this long-run imbalance between supply and demand in the housing sector. And so despite the moderation in activity, house prices and rents still remain quite high. And why that's important is that it typically takes some time for that rent, those high rents, to actually flow through to the shelter component in the inflation measure. So basically, we're going to see inflation elevated for some time as that flow through comes in, even though activity in housing is slowing down. So the more recent data in the July reading of the PCE and core PCE inflation showed a bit of moderation, which was very welcome news. Everyone applauded that. But then when the August CPI report came out, it really underscored that those inflation pressures were continuing and they remain intense. If we look at a variety of measures of underlying inflation, and I'm showing a bunch of them here, trim mean and median CPI and PCE measures, they show that inflation pressures are elevated and they're broad-based, even though economic activity is moderating. Measured year over year, the median and trim mean inflation rates were either stable or actually increased in July. And in August, the median and trim mean CPI rose. They did not fall. And I'm not showing it on the chart, but if you look at wages, wage pressures are also contributing to the high inflation we're seeing. Wages are still growing much faster than what would be consistent with 2% inflation. And at least when I look at the data, I don't see much in the way that says wage inflation is, those wage pressures are abating at all. So if you look at, these are the FOMC summary of economic projection, median PCE inflation projections. So 4 times a year, FOMC participants put in what their projections are going to be for the big variables, GDP growth, unemployment, the unemployment rate, inflation, core inflation, and then what funds rate path is appropriate given what the outlook is. And if you just look at this chart, it really shows you that there's been this evolution because inflation has just been much more persistent and much higher than FOMC participants. And I would submit a lot of economists thought it would be over time. And, you could look at this and say, wow, that's a really bad track record. We haven't done a very good job of predicting inflation. And I would agree with that. But I think it's going to remain challenging because there's just a lot of things that are affecting both the demand side of the economy and the supply side of the economy. And remember, this inflation is driven by these imbalances between the demand sides and the supply side. So, there's the war in Ukraine, the energy situation in Europe, the global economic outlook, property market stresses in China, and the lockdowns in China, which of course affect the supply side. There's the sentiment of consumers and businesses and their reaction to the elevated inflation rates we're seeing. Again, supply chains, maybe there's some evidence they're easing, but not everyone sees that. And then labor force participation rates that are going to be moving over time or not moving over time. So, this imbalance between supply and demand, that assessment of that is going to be really important for actually forecasting and seeing the outlook for the economy. But I think there's just going to remain a lot of uncertainty around the inflation outlook and forecasts. And we have to understand that inflation is going to continue to be hard to predict. Now, one of the big things that we've learned, I said we have learned from past episodes, is that it's much more difficult and costly to bring inflation down once it has become embedded in the economy, meaning once businesses and households expect inflation to remain elevated, and that expectation of high inflation influences their savings and investment decisions and price and wage setting behavior. So we know that high inflation imposes costs on households and businesses in the short run. It eats into savings. It makes it hard to plan for the future. But it also affects the long run, making it hard to evaluate investment opportunities. And so what that does then is it can affect productivity growth, and that actually can affect long-term standard of living for the economy. So it is really important that inflation move back down. And in fact, when the Fed put out its new framework for how to do monetary policy, it really recognized and underscored the importance of keeping inflation expectations anchored at levels consistent with 2% inflation, the long-run goal. And when I say well anchored, what I mean is inflation expectations, longer-term inflation expectations that are insensitive to the data. In other words, they are anchored in terms of being consistent with 2%, the long-run goal. So inflation expectations have been a central factor in models of inflationary dynamics since the 60s and 70s. In many of the inflation models that central banks use, inflation is driven by three factors. One, some measure of resource utilization gaps, like the output gap or the unemployment rate gap or marginal cost of production. Lagged inflation, which is trying to get at the fact that there's inertia in the inflation process. And then expectations of inflation. And different models, depending on which model you look at, put different weights on those three factors. But the expectations matter in the models. And it's because of what we talked about earlier. They affect wage demands and price setting behavior. Now, in addition to the role that they play in the dynamics of the inflation process, they also provide an indication about how credible the public finds the central bank's commitment to achieving its policy goals. So it's really important that we anchor those inflation expectations, and they can tell us whether people actually believe that the Fed is going to do what it needs to do to get inflation back down. Now, the other important thing about inflation expectations, when they're longer-term inflation expectations that are well anchored, according to the theory, right, they can actually mitigate some of the pull that resource gaps could have on inflation. So in other words, right, the cyclical movements in interest rates that policymakers induce to maintain price stability don't need to be as large as when inflation expectations aren't well anchored. And that was particularly useful when we were at the zero lower bound. If you remember, back then, right, that lower bound constrained what the Fed could do with interest rates. And it's arguably the case that the US might have suffered much lower inflation during the Great Recession if inflation expectations hadn't been stable or relatively stable. So the counter is, in today's environment of very high inflation, keeping inflation expectations well anchored should help to bring inflation back to goal without as large a change in the output gap. So this soft or softest landing that people talk about. Now, that's the theory, right? We know that sometimes, even if the theory is very compelling, the real world doesn't cooperate. If you think about Japan, right, inflation expectations have been running well above actual inflation for a number of years. So one of the problems of moving from theory to practice is that we don't really have a direct measure of inflation expectations. They're not really directly observable. So what we end up doing is we look at a bunch of different measures. They differ by type of agent, like households versus forecasters versus businesses, and they differ by time horizon. So, and then there are measures that actually combine various measures into like a composite index. The problem, of course, is that you don't always get a clear signal. Things can move in different ways. Different groups of agents can have different expectations. And we see that in a variety of measures over time. And even within groups, like if you say households, there's differences by a lot of the research we've done at the Cleveland Fed, or differences by gender, differences by age in their expectations about inflation. And there's differences by experience. If you've had a high inflation episode in your past, you think about it differently in the future. Okay, so the research also tells us that short-term expectations tend to move with gasoline prices and other prices that are salient prices like food prices. Longer-term expectations and their level relative to short-term expectations give a better sense of whether expectations are becoming unanchored from the target. And that's important because that gives you an indication whether inflation is becoming embedded in the economy. You know, it's a signal of that. And then relatedly, they give you a sense of whether the credibility of the central bank in the eyes of the public. So if longer-term expectations remain stable in the face of a positive shock to inflation, that would indicate that the public, believes that inflation is going to come down. Although it's arguable whether they believe it's going to come down because of actions that the central bank is taking, right? Then they have to have a model in their mind that says that over the longer run, inflation is this monetary phenomenon or not. But nonetheless, it really is a signal that, monetary policy or the policymakers are on the right track. Now, the rise in inflation expectations we've seen since last year has been concentrated in short-term expectations. And they did rise, as the theory suggests and empirical work says, with food prices and with gasoline prices. More recently, right, when gasoline prices started coming back down, those short-term measures have come back down, okay? I would point out, though, that they still suggest that people think that inflation is going to be high over the next year. Now, medium and longer-term expectations have moved up less than short-run expectations, and they're below current inflation levels. So that is an indication that the public believes that inflation is going to move back down. And if you look at the New York Fed's measure, they have a 3-year, from surveys of consumers, a 3-year measure of inflation expectations, which is a medium term. And also the University of Michigan's longer-term expectations, those have moved down recently. And that, again, is welcome news. It's good to see them moving back down. But I would point out that the measures are higher than they were pre-pandemic. And as I said, right, these should be less sensitive to gasoline prices and to food prices and to those short-run fluctuations, and more reflective of consumers' expectations about or perceptions about the Fed being committed and doing what we need to do to return the economy to price stability. And if you look at the timing, you did see, right, when the Fed started talking that we were going to get inflation down, when we changed our communications, started emphasizing that we were going to take decisive action against the high inflation, you did see some movement down in those expectations. And that might be a suggestion that there's good anchoring there. On the other hand, right, it also coincided with a move down in gasoline prices. So it isn't clear yet that the measures won't move up again if we see gas prices rise, food prices remain high, or inflation developments take a turn for the worse as the year progresses. The other thing you can look at is dispersion in the long run inflation expectations. And you look at across the survey respondents, where are they coming out in terms of the distribution of their expectations. And I would say in this case, the episode now, the recent data are mixed. If you look at surveys of professional forecasters, and this is from the Philly Fed, right, those expectations haven't risen much. They've only risen modestly. And the dispersion, right, is actually quite narrow. And most of that increase, I would say, if you do like a five-year forward, that's basically still 2%. So again, they see inflation up in the near term, they expect it to come back down, not much dispersion. If you look then at the University of Michigan surveys of consumers, here you can see it's quite a bit different. There's quite a big increase in dispersion since the start of the pandemic. And early in the, it was driven by an increase in expectations at the top part of the distribution, that 75th percentile. More recently, what's going on is that there's been a downturn at the bottom of the distribution. So there's a group of people who think that inflation is going to be well below our goal. And that could be a reflection of their view about the economy, right? Their expectations for the economy. So the point is that when you see large dispersion and you see it moving and getting larger, that could be an indication that inflation expectations among consumers are not as well anchored as we'd hope they would be. Okay, so since March, the FOMC has raised the target range of the Fed funds rate, cumulative 3 percentage points. And in June, we began reducing assets off of our balance sheet according to the plan we announced in May. This has been a relatively fast pace of tightening, but put it into context. If you think about the outlook and the current level of inflation, I believe we're going to have to increase our policy rate more. And I think in order to put inflation on that sustained downward path to 2%, we're going to have to move policy into a restrictive stance. Real interest rates are going to have to be in positive territory, and they're going to have to remain there for some time. So again, we released these new SEP projections last week, and you can see just the path up, right, all year, the policy path that we deem as appropriate moved up again in response to data, right? And when they say that the Fed is data dependent, I think this shows we are data dependent. Data comes in, we think about what are the implications of that data for the outlook, and then what do we have to do to achieve our goals. We've seen this shift up in the policy paths over time. So, I mean, if you match this up with the chart I showed earlier where the inflation rates have been much higher and more persistent, it's clear why this has to be what's going on with the expected policy path. So, we're just going to have to move rates up, and rates are going to be held higher for longer than we thought previously. Now, we are operating in a very uncertain environment. And as I said, assessing that balance between supply and demand is going to continue to be challenging as we go through this. So if you think about how does policy react in an uncertain environment, there are results in the theoretical literature that basically say that when policymakers confront a lot of uncertainty, either in the data or in their models, right, not knowing which model applies, what they should do is be very inertial. All right, so there is results in the literature that show that. Subsequent results in literature show that, well, that's not a general proposition. That's not generally true. And people like Tom Sargent has done a lot of work that basically points out that caution doesn't necessarily mean doing less, right? You can be cautious in different ways. And so, when there's a lot of uncertainty, it can be better for policymakers to actually act more aggressively, because aggressive action and preemptive action can prevent the worst case outcomes from happening. So you're being cautious, right? It's just that the prescription is that you actually be more aggressive to prevent some of that downside from happening, those bad outcomes from happening, or worst case outcomes from happening. And then Carl Walsh also has some results that are pretty robust across models that, basically the lesson from his work or the takeaway from his work is that you get better economic outcomes by assuming that high inflation will be persistent, right, and then acting accordingly. Again, this is a little counter to when there's uncertainty, be inertia, right? So I want to follow that robust control view. And in current circumstances, I'm planning to be very cautious and not assume that if we see 1 or 2 improved readings on inflation, it'll mean that inflation's on a downward path. And I'm going to be cautious about assuming that inflation expectations are firmly anchored when I see that they are still elevated. It's kind of easy to just have wishful thinking, but we can't have wishful thinking replace really compelling evidence. So you have to force yourself as a policymaker, just, even though you saw like a good inflation reading, you really have to steer yourself and not sort of be distracted by that. So like before I conclude inflation has even peaked, I'm going to need to see several months of declines in the readings, in the month-over-month readings. And I'm also going to be, guard against being complacent about long-term expectations. I'm glad that we saw them come down, some of the longer run and medium runs, but my view is the longer inflation remains elevated, the higher the risk that inflation expectations do become unanchored, and firms and households begin making decisions based on persistently high inflation. And if that were to happen, if inflation expectations were to become unanchored in that way, then returning the economy, right, to price stability would be much more difficult and more costly. More costly in terms of lost output, more costly in terms of higher unemployment. So, and again, there is a lot of research out there that basically says, you're in this world of uncertainty, right? And you have to realize that there could be two-sided errors or two-sided ways, risks to it. But the research basically says that you're better off, the more costly error is going to be assuming things are well anchored, right? And assuming inflation is going to come down and acting like that, right? Rather than, and finding out, oh, you were wrong, it wasn't well anchored and inflation wasn't moving back down, rather than the opposite, right? Of acting as if inflation is persistent, acting as if inflation expectations aren't as well anchored as you thought, right? That could end up being wrong ex post, but you get better outcomes if you don't make that assumption, that you're better off assuming that inflation will stay high and then acting accordingly, because you can also always back that out later on. You want inflation expectations to be helping you, right, get inflation back to your goal. Okay, so in summary, price stability is this foundation. for sustaining maximum employment and a healthy, productive economy over time. The FOMC, I think, is showing that we're resolute in putting inflation on a sustainable downward path to 2%. This is going to be painful. There's going to be bumps along the road. We've already been experiencing some of that, right? Because we've got to get growth in output and employment to slow, and the unemployment rate will move up. But, you know, the way I view it is that we already are suffering pain, right? There's many households, many businesses, right, are already feeling the pain of the high inflation rate. So this isn't like, you know, we can't avoid pain. We're going to have pain, and this is a very painful situation. So I personally don't view this as a trade-off of our two goals, right? I really view that, you know, if we weren't going to take decisive action to get back to price stability, to get inflation down, to get inflation expectations really firmly anchored, the costs would be very high. Basically, we would not be able to sustain healthy labor markets over time, and that's very detrimental to the public as well. So again, you know, I really think this is a time for us to be decisive, and I think we're proving to be so. So thanks for your attention, and I'm happy to take questions.
So thank you very much, Loretta. I remind people that we are live streaming as well. So when you ask a question, if you can wait till you get the mic, so that not only the people in the room can hear your question, but also people that are watching virtually. And we're going to take some questions from people that are watching on the live stream and some from people in the room. So anybody want to lead off? Athanasio, what a surprise. Let me pass the mic over to you. It's going to go over the top, sorry.
So Athanasios Orfanidis, MIT Sloan. So President Mester, thank you so much for this wonderful presentation. And I very much agree with the way you concluded about how the risks at the moment are actually closer to Tom Sargent's characterization of how policy should respond to an uncertain environment. But when I look at all of the charts you've shown us, this doesn't seem to be what the FOMC has been doing over the past year and a half. What I see in the chart you have presented from the summary of economic projections, for example, is more consistent with the view that the FOMC consensus is assuming the benign scenario, that inflation expectations are well anchored, and gradually tightening the nominal interest rate, while not even tightening in real terms. So the question I have for you really is, after over a year of seeing these risks on inflation, why is it that the FOMC is comfortable with having policy that is still not restrictive, with the nominal interest rate still considerably below inflation and projected to stay like that for quite some time?
So excellent question. I mean, different people have different ways of measuring real interest rate, right? So you're taking, I think, the view that we take inflation at the moment and subtract that off of our nominal funds rate, and that'll tell you whether we're still in negative territory. I would suggest that there are other ways of viewing where the real interest rate is, which means that maybe it's right below what would be a, you know, restrictive policy rate, which is why I think we have to do more, right? We need to get real interest rates into positive territory. I think it's debatable about how far up the nominal rate has to be to get us into that, you know, positive real rate. In the long run, right, my estimate of the neutral in the long run real rate is 0.5 percentage point. So again, right, we're not there yet, right? And given inflation is elevated, we got to get above that. So I agree with you in terms of more work has to be done. The question is, you know, I can't really say whether that path, that's the median path, is the appropriate path, but that's the consensus among the participants that that's what it's going to take. But my view is we're going to have to do more, and we've got to be willing to bring interest rates, the real funds rate into positive territory, as you suggest, and keep it there. If you go back to that chart, which I won't find because I'm sure I'll screw it up, you know, the rates aren't coming down next year. They're staying up. And I think that's what's going to be necessary to actually get this policy on the path, inflation on the path that we need to get. So I don't disagree with you.
Hi, my name is Anviti Bahuguna. I'm from Columbia Threadneedle Investments.
It should be on. Just put it
Okay, I'll bring it closer. Is that better? Anviti Bahuguna, Columbia Threadneedle Investments. So I'm going to actually take the opposite side of that view, which you probably see on the committee. I'm looking at medium to longer term real rates, and if 0.5% is neutral, I'm seeing the 10-year real rate at 1.5% this afternoon. And I'm seeing the difference between the Fannie Mae coupon rate and the 10-year swap at the highest I've seen in my career. And I've been at it for 25 years or so now. So to me, it looks like the Fed has tightened plenty, taking into expectations markets pricing your forward view for 2023 and 2024. And it's having damaging impact on the mortgage market and on the swap rates. Do you see yourself thinking about the long and variable lags of tightening, which are not going to show up in the next 1 to 2 months of inflation data, and are probably better predicted in this medium to longer term bond market data?
So 2 things. One, the 0.5% real rate is a short rate, not what you get on the long end of the curve. So just to be clear about that. You're right. At some point, right, we'll have done enough that it actually becomes, you know, where are the risks, right? So this is all about risk management, right? And at some point, you know, it'll be a case where we're going to have to sort of balance those risks. This is not that moment, right? This is not that moment because inflation is persistently been and is forecast to continue to be high and very much high above our goal. So we're going to have rates continue, the short rates, our policy rate continue to move up in order to get inflation to come back down. That's very clear, right? At some point, you're right. You know, the risks, right? Then we can do that balancing of risks that you're talking about. Well, demand is going to be slowing even more. Supply conditions may improve. We don't know, but you know, we've seen some maybe tentative signs that that's happening. Maybe people will come back into the labor market. So that kind of thing that you're talking about will happen at some point. This is not the time for that. This is the time for really recognizing that even though demand is moderating, and you're right, we've seen most of the demand moderating in the mortgage market, which is very interest rate sensitive, right? It hasn't affected really inflation yet. And we have to start seeing that happen before we can get to the point where, okay, we're now seeing that things are getting into better balance. I certainly don't think we've seen that yet. So I agree, we're going to have those conversations, but we have to have those conversations later on once we see demand really moderating and we've gotten interest rates into that, you know, restrictive stance. We haven't really we're right on the cusp of that. We haven't gotten there yet.
Question over here to the left.
Yes, my name's George Hogue, and I'm in the investment management industry here in Boston. My question has to do with your view on long-term structural factors in the world economy that might be potentially fueling inflation and which will complicate the task of getting back to target. So let me just name a few: reshoring and China trade tensions, global warming, the transition to clean energy, obviously the Ukraine conflict, and importantly, slowing population growth. So US population growth last year, I believe, was 0.1%, and we've restricted immigration significantly. So I guess the question is, how do you think about some of these issues in terms of an inflation target and the path to getting to neutral?
So that's a really good question, and I think that some of the things you point out may have longer run implications for those. You know, when I talked about sort of the earlier during the long 10-year expansion pre-pandemic, right? There were pressures on holding inflation down. Some of the factors you pointed out may be pressures that'll keep inflation up once we get beyond this episode. In terms of this, you know, where we are now on the inflation, those things aren't guiding my view on what we need to do now with monetary policy to get this inflation to come back down. And it's not informing my view. Our target is 2%, long-run inflation of 2%. We're going to get there. But I do think that you're pointing out there are some reasons to believe that there's offsetting factors now. We might have the factors that were holding inflation down, some of those come back, but we may have these other factors. I mean, the immigration thing is a good one to point out because, you know, we've talked a lot about, well, why haven't people come back into the workforce? So that's a long run issue. We knew that a lot of people retired, right, and sped up their retirement during the pandemic. That's one of the big factors. But reduced immigration is another, you know, that would be, if we could get immigration back up, that would be another source of labor, right, that then could get the labor market back into better balance. But in terms of the near run, do I think that's going to happen? No. And so I have to say that's a factor that we have to take as part of the environment and then think about where monetary policy needs to be.
Next, a question from somebody from online.
Yeah. By the way, we have over 100 people online, so it's you've drawn quite a good audience. A couple of questions, but one was around real-time data. You talk about lags and uncertainty, but with sort of big data out there, do you have a measure of what's happening today to inflation, and how does that factor into your decisions?
So real-time data, something near and dear to my heart. We're actually doing a conference in Cleveland in a couple of weeks on real-time data. We look at a bunch of different statistics for sure, but nothing can beat sort of what's happening on the ground. So that's why, you know, a lot of the regional reserve banks, and mine included, we spend a lot of time talking to businesses and to households through our business advisory councils that are distributed across our district, to our directors, boards of directors, to our community development contacts. They really can tell you a lot ahead of the data, right? So that's why during this whole pandemic, it was always valuable before, but during the pandemic and the aftermath of the pandemic is when the economy reopened, and now certainly this has been a very rich source of information that helps inform our views, because you do have to take into account that data get revised, many of the data get revised, they lagged, you know that, and so you take all this great information that you're getting on the ground and from the data sources, and then it's not just moving on one data point. Sometimes I get worried that when we say we're data dependent, people think we're moving on one data point. That's not what we're doing, right? Or certainly not what the Fed is doing, right? We're taking that data, and then what are the implications of that data for the outlook and the risks around the outlook, and then that informs what you have to do with policy. So I would say the short answer is we talk to a lot of different people that give us a lot of good information about what's happening on the ground right now and what their views of what's happening in their business. So a number of firms over this period, and even now, say, you know, there's some concerns out there about, you know, we're going into a recession, but my firm is fine. I have orders. I have an order book. You know, my big problem is I can't get workers to fulfill the orders. So again, it's perceptions about the general economy don't necessarily reflect what's actually happening in their own firms.
Another question here to the left.
Thank you very much for coming. I've always enjoyed your writings, and I continue to do so.
You put the mic closer to you.
The name's Eric Joscom, and I'm a member of the Boston Economic Club, and I think now for 38 years.
I'm sorry, I can't hear over here.
Do I have to push this?
No, you just have to put it closer to your mouth.
Oh, all right. What seems to bother me with all the data and the challenges that you have with it is that we have more and more variables coming up virtually every week. And now we have this somewhat awkward situation with the high roll of the dollar and other currencies. And do you see the risks associated with us exporting inflation to other countries, which in turn, when and if the dollar will roll, which I assume it will, that will compound the strategies that you're currently embarked on?
That's a good question. I mean, we've seen what's going on in the financial markets today. The mechanism will be through the financial markets and whether they're functioning or not, right? So we're going to set monetary policy that's appropriate to the U.S. economy, but we don't set it in a vacuum thinking that we're an independent island and we're not connected to the rest of the world. I mean, we saw that with what was happening with the lockdowns in China. That affected our economy because it affected the supply side of the economy. Similarly, right, we don't set the value of the dollar, that's set in the markets, but we have to understand, right, what impact that has on the U.S. economy in terms of our trade balance, right? And so that's one way mechanism that flows through, but also in terms of financial market volatility, which can affect sort of investment decisions made here, right? So there are interactions there, but in terms of our goals, we're going to set our policy taking into account the environment we're in order to get back to price stability here in the U.S.
Hi, my name is Patrick Adams. I'm a PhD student in finance here and also started out my research career at the Cleveland Fed as an intern.
Really?
So I wanted to ask about state-dependent forward guidance. In the recovery from the great financial crisis, I think the Fed had success in communicating to the public its commitment to keeping rates low for an extended period of time through the Evans rule and specifically forward guidance communicated through unemployment targets. Now we're facing upside risks to inflation. Do you think there's any role for similar state-dependent forward guidance, but communicated in terms of managing upside risks to inflation rather than downside risks to real economic activity?
I think we learned through our episodes and experiences that forward guidance can be helpful, but it can also be not as helpful as you'd like it to be. So right now, I think we're doing a pretty good job of communicating to the public where we're going with policy. And I use it, and I know there's just different views about the value of the summary of economic projections. I'm a fan of them. I think they do communicate information. Can they be improved? Yes, and I've talked about that before. But that's, I think, a good way of looking at, well, at this moment in time, given where their forecasts are, this is where they think policy needs to go. You've also seen that can change over time, so we're not locked into something. I think one of the issues that you guys, actually you can study this when you do your dissertation. You can write about whether the forward guidance that we had last year, whether that, I get a question a lot, like, is it your framework, the fact that you changed your framework that got you into the inflation bind or not? And my own view is, I don't think it was the framework. The framework, if you actually read the framework, stands. I think the forward guidance we had was probably not as formulated as well as it should have been. So again, I think you're right. In general, forward guidance can be a tool of monetary policy. I don't think it's going to be that helpful in this environment. And I think I would look to the statements, the press conference, and the SEP as a pretty good indicator of where we're going.
Yeah, Mark Williams, Boston University, and also president of the BC. Quick question. We think about this balance sheet that the Fed has developed and grown over since the financial crisis. And in particular, what is the long-term strategy with the over $1 trillion in mortgage-backed securities? Will it be unwound, or will you just allow them to fall off when they mature?
Okay. So right now, we have a plan where it's allowing them to roll off, as they mature up to a cap. But we have indicated, and we indicated this in the March minutes to the FOMC meeting, that participants generally favor talking about a strategy for selling some of the MBS. Because remember, one of the things that we want to get back to is a portfolio that's primarily Treasury securities, right? And I support that because I think going into other markets, has credit allocation aspects to it, and so we want to back off from that. There's no active discussion of that at the moment. Right now, we're just singularly focused on reducing accommodation and using our Fed funds rate policy tool as the main tool to do that. But eventually, my hope is that we would have a discussion about selling some of that portfolio so we could get back faster to that primary Treasury portfolio.
President Mester, thank you very much for being here today. My name is David Lindsay. I'm a past president and 42-year member of the Boston Economic Club. My question relates to wages, which seems to me to be one of the toughest conundrums. On the one hand, we don't have enough workers, which argues for paying them more. And on the other hand, as you said earlier, the current wage increases they're getting of 5.5%, while not being enough to draw enough of them out of the unemployed ranks, is too much for 2% inflation. And so it seems we're in a situation where we need to pay them more and pay them less. And I wondered how the Fed looks at possibly resolving this seeming conundrum.
Yeah. Well, I think what you're pointing out is that, right, we want to basically slow demand in order to get demand, right, in better balance with supply. If the supply of labor stays as constrained as it's been, you're right, that's going to take a little bit more effort, right? But then eventually wages do, move down. So again, it's this imbalance between supply and demand, realizing that labor force participation may stay at the current levels, right, and not move up much more than where it is now, and then there'll be more work to do there. But right, that equilibrium has to be reached, and the tools that we can do in monetary policy are on the demand side, not on that supply side. Other things that we talked about earlier, like immigration, that could help on the supply side, but that's not something in our realm.
You can pass the mic back to Jim Paterno.
Yeah, thank you so much for coming. This is really fascinating. Jim Paterno from MIT. I wonder if you could say a little bit about thinking through the power of interest rate tools today versus historically, and maybe particularly in the housing area, where, as you alluded to, we're coming off a red-hot housing market. There are two things that might happen as we tighten. We've all heard that transactions are down, so there's already some effect even of the rate hikes so far. Right. But do you see a way to get prices down, which would then flow back into the inflation measures, or do you think what mostly happens is that you constrict new building and therefore it's a demand for goods kind of channel that this works through? I mean, and timelines. I mean, the house prices seem to be notoriously sluggish to respond to pull-ins in demand. So any thoughts on that complicated set of issues? I'd be very interested.
Well, it is complicated, right? Because even before, right, even before the Great Recession, right, the supply of housing has been constrained for a long time, right? So there's that structural thing going on, right? And then layer on top of it the cyclical, right? Are we going to be able to get, and the demand for housing, of course, was affected by the pandemic, right? So you had sort of the longer run structural issue, the shorter run, median run, pandemic demand side factor, and then you have now the cyclical factor where we're raising interest rates up. I mean, do I know exactly how it will play out? I don't, but I do know that at this point, one thing that's a positive in terms of how this will play out is the banking system is healthier than it was. We don't see the excesses that we saw, like in the subprime mortgage market, in the crash, all that. So in that sense, right, there is going to be, it's going to be sort of a bringing that activity down to get the equilibrium back to then bring prices down. But I think the economy at this point can handle that because the financial system is in much better shape in terms of that. And I don't know whether that helps you or not.
Yeah, there's one housing question. I think you answered it mostly. But there is this idea, at least the question, is that house prices are already falling. Does that factor into your thought? And let me ask one more question, because we have lots of them from the audience here. What about corporate profits, and how does that factor into your thinking? Some people refer to it as price gouging. The corporate profits are up. How does that affect your view of inflation?
Well, I mean, there is a bunch of people out there saying, well, there's still, the margins are still up, high, and so that's actually, there's more work to be done there in terms of getting demand into better balance with supply, right? But set aside that, right, then it's about just let's look at what's happening with prices, right? So from our point of view, right, we need to see inflation coming down. In the housing market, that mechanism is going to be a mechanism to do what we're trying to do, which is moderate demand and get it into better balance. We'll see the effects in housing faster than in other sectors because it's so sensitive to interest rates, right? We likely are going to see it in the auto sector because, again, more interest rate sensitive sectors. But that's the mechanism, through the transmission mechanism of policy. So yeah, it figures in because it's going to be instructive to us about where is inflation going and what's the outlook for inflation. Right now, right, we haven't seen much of the moderation in demand feeding through in inflation, but it certainly informs the outlook in terms of inflation. And that will eventually, once we get interest rates up to a restricted level, certainly be part of thinking about what's the next step, or where do we go from here, kind of thing.
So I think we'll make this the last question. You've been very generous with your time, so let me bring the mic over for the last question.
Thank you very much for a wonderful presentation, Ms. Mester. My name is Kristen Polito. I'm with Merrill Lynch. And Bank of America came out with a recent report today that they're projecting unemployment will increase to about 5.5% by the end of year-end 2023. How close are you watching unemployment? Do you have a definition on redefining maybe full employment? It had been 3.5%. And will this be one catalyst for continuing your restrictive policy or easing up as demand goes down, as unemployment goes up?
Right. Good question. I haven't seen their report that they sent out today. I mean, certainly we're focused on both of our goals, right? We have a dual mandate, right? We have inflation, price stability, and then we also have maximum employment. I haven't changed my view of the long run U-star or long run unemployment rate. So I wasn't at 3.5. I was above 4 on that. But in any case, right, we do expect, and I do expect, the unemployment rate to move up. I don't have it moving up as much as the number you quoted, but I do have it moving up because, again, right, we're at very low, right, unemployment rates. We have a lot of imbalance in the labor market between supply and demand, right? And the mechanism for getting inflation down is to bring both product markets and labor markets into better demand. So I do expect the unemployment rate to rise, but not to that extent.
So I'd like to thank Loretta for wonderful answering all those questions, a wide variety of questions, and thank you for coming to MIT to give a wonderful presentation.
Thanks for having us.